Hello traders, we have received a question from a trader that was wondering why there are instances when his trades get filled at a different price than the ones he requested. So as to help you understand this, we have decided to do a video that outlines conditions that lead to such an occurrence, which in Forex trading is termed as slippage. Slippage is a common occurrence in trading, but many are the times when traders think that the broker is trading against them or something weird is happening. As a trader, if you understand how slippage occurs, you'll be able to minimize the risk of negative slippage while maximizing on positive slippage. Slippage occurs when a trade order is filled at a price that's different to the requested price. Normally, it occurs during periods of heightened volatility or when an order cannot be matched at a trader's desired price. Slippage in Forex tends to be seen in a negative perspective. This can be true, as your order can be filled or your stop can be executed at a worse price than you intended, which is referred to as negative slippage. However, this normal market occurrence can also be good or can be a good thing. When your Forex trading orders are sent out to be filled by liquidity providers or banks, they are filled at the best available price, even when the price below is the price requested. This is called positive slippage, or rather, we call this positive slippage. That is when slippage works in favor of your entry or in your trade. For instance, let us say you try to buy Euro USD at a market price of 1.0850. When the order is filled, there are three potential outcomes that can happen. The first is there is no slippage. The second is positive slippage. And then the third instance is a case where there is negative slippage. In the case there is no slippage, your order will be submitted and will be filled on the best available buy price, that is 1.0850, which is the exact price that you requested. In another outcome, your order will experience positive slippage. So you submit your order, but the best available buy price suddenly changes to 1.0840. This is 10 pips below your requested price, meaning your order will then be filled at a better price, which will be positive slippage or slippage in your favor. That scenario is where your order is subjected to negative slippage. This is when your order is submitted but the best available buy price suddenly changes to 1.0860. That is 10 pips above your requested price. In this case, your trade will be opened at a worse price than you requested, which is the negative slippage as we have seen. Traders often wonder what the causes of slippage in Forex markets are. The simple answer to this question lies on what a true market consists. Typically, we have to mention that a true market consists of buyers and sellers, or rather, buyers and sellers of currencies. For every buyer with a specific price and trade size, there must be an equal number of sellers at the same price with the same trade size. If there is ever an imbalance of buyers or sellers, prices will tend to fluctuate, that is, moving up and down. If you attempt to buy 100,000 units of Euro USD, for instance, at 1.0850, but there are not enough people willing to sell their euros at that price, your order will seek the next best available price and buy those euros at a higher price, which will leaned to negative slippage. On another instance, or on the other hand, if there was a flood of people waiting or wanting to sell their euros at the time your order was submitted, you might be able to find a seller willing to sell the currency at a price lower than what you'd initially requested, which will lead to positive slippage or slippage working in your favor. Forex slippage can also occur on normal stop losses or on normal stop loss orders, where the stop loss level cannot be honored, during which your stop loss or stop loss order will occur at the best available price. It is worth noting that under normal market conditions, the more liquid currency pairs will be less prone to slippage. That is, currencies such as Euro USD, USD Japanese yen, sterling pound versus USD, USD CAD, USD Swiss franc, and so forth and so on. Although, when markets are volatile, like before or during an important data release, even these liquid currency pairs can be prone or are prone to slippage. It is important to note that news and data events can increase volatility significantly, or rather, as I have seen, they often experience increased, or the market experiences a heightened increase in volatility. Traders should therefore remain alert by keeping a keen eye on economic calendars, news, and forex analysts to understand the market dynamics that are happening during a trading day or at any given point in a trading day. Thank you for watching, and as usual, let us meet again in our next trading video.